Hello, and welcome to Navigating Estate Planning with Caress Law. I'm your host, Tammi Caress, and today we're diving into a topic that's on many people's minds as they plan for the future and the future of their loved ones: taxes. More specifically, estate taxes and also some gift taxes. Understanding these types of taxes can be crucial for effective estate and legacy planning, especially with some significant changes on the horizon. So let's get started. And now it's time for the disclaimer. The information contained in this podcast and associated material is intended to furnish listeners and users with general information on matters that they may find to be of interest. The information in this podcast provided by Caress Law and its agents are for general guidance and is not intended to replace or serve as a substitute for any advisory, tax, estate planning, or other professional or legal advice, consultation, or service. Sometimes we may reference third-party materials or websites. Such links or references are only for the convenience of the listener, user, or browser. Caress Law and its agents do not recommend or endorse the content of third-party information or sites. You should consult with appropriate Caress Law professionals or other professional advisors for advice concerning specific tax, estate planning, or other matters before making any decision. In summary, this podcast is not legal advice. If you need legal advice or before acting or making any decision with anything talked about in the podcast, seek the counsel of an attorney. Thanks so much. Estate taxes. What are estate taxes? The estate tax is a tax that is assessed on the gross value of a deceased person's assets when they pass. I do have a previous podcast episode talking about estates and what all estates encompass. To give you a short version today, when we're looking at the gross estate value, we're looking at the value of the assets or the cash in bank accounts, the value of stocks that the person owns, the value of real estate, the business value if they own a business, your automobile value, boats, any other stuff, if you will, inside your home, jewelry, antiques, art, down to the silverware in your silverware drawer. So we look at the value of all those assets as of the date of a person's death, and we total that value up. If that value is more than the threshold set by the federal government or on the state level, then that estate is subject to estate tax filing requirements and possibly payment of the estate tax. We call the threshold the exempt amount. So the exempt amount is the amount that can pass tax-free. On the federal level, if a person's estate today is under $13.61 million in value when that person passes, they are not subject to the federal estate tax. So as of recent years, the federal estate tax in terms of planning has not affected a lot of people. It's only our real high net worth people that have been affected by the estate taxes. There is, however, state level estate taxes, and I practice and my firm practices in both Oregon and Washington, and Oregon and Washington are states that have an estate tax. There's only about a quarter of the states in the US that have an estate tax. Oregon and Washington are one of them. The estate tax exemptions for Oregon and Washington are much lower than the federal exemption. In Oregon, the exemption is $1 million. That means that if you are a resident of Oregon at passing, or you own real property in Oregon, you could be subject to estate taxes if the gross value of your assets, no matter where they're located, inside or outside of Oregon, or even inside or outside the US, is over $1 million. In Washington, the threshold or the exempt amount is just under $2.2 million. Same thing if you are a Washington resident at passing or you own real property in Washington. The total value of your assets, no matter where they are located, if they are over $2.2 million, the estate is subject to an estate tax filing and potentially estate taxes. Now, on the federal level, the estate tax exemption is adjusted annually based on inflation. So it has gone up over the years because of inflation. For Oregon and Washington, it is not adjusted annually for inflation. That exempt amount stays at the level set unless it is actually changed through the state legislatures. Some things to consider, especially when we are in election years, is that the federal exemption over the years for estate taxes has changed quite a bit. When I started practicing 20 years ago, the federal exemption was much, much, much lower, and more people were subject to estate taxes. Now it's that $13.6 million threshold. It will likely go up next year in 2025. However, so long as no changes in the law are made, in the end of 2025, actually January 1st, 2026, that estate tax exempt amount is going down. It will be going down to $5 million per person adjusted for inflation. That means it's probably for estates that are valued around 6 or 7. We won't know until then, but that's probably around what it will be. So it is going to drop quite a bit. And when it drops, there are going to be a lot more people subject to that federal estate tax. Now, again, you never know. It could change, and there are proposals out there for it to change on the federal level. And it is very common, frankly, for it to change when we have a new president that's in office. So I'm not quite sure if it will change, but based on current tax law right now in 2026, that threshold is going to reduce quite significantly, and more people need to be aware of that. And also there are planning opportunities that can be done now in contemplation of that decrease in the federal exemption level. So let's talk about how this kind of works. Essentially, when a person passes, we're valuing all the items based on the value of the date of death. And if the total value is over that amount, they're subject to an estate tax filing. Now, if the deceased person is married, there are some planning opportunities that we can make available. And I've actually talked about some of these in prior episodes. I won't go as much into some of those. But what I want to describe to you is the portability, what we call the portability election. When a couple, married persons, are together and a spouse passes away, the deceased spouse has their exemption amount, which today, $13.61 million. The surviving spouse also has their own exempt amount. Now, they're still around, so keep that in mind. When the first spouse passes in a marriage, the surviving spouse can actually keep, if you will, the deceased spouse's exemption. So if the surviving spouse has their own exemption, which they do, $13.61 million, and the deceased spouse passes away and they don't use their exemption, which is $13.61 million, the surviving spouse, as long as they file the appropriate paperwork with the federal government, actually has a new exemption of $27-ish million. So again, this is why we have not been as focused and concerned about the federal estate taxes, is because of what we call portability, the surviving spouse being able to use deceased spouse's exemption. Now, when I say used and unused, when a spouse dies and gives everything to their surviving spouse, there's an estate tax marital deduction, which basically means there will not be an estate tax due when the first spouse passes away. And therefore, the surviving spouse on the federal level inherits all the assets, and they've increased their exemption. They've basically doubled their exemption available when they ultimately pass. So we call that portability. On the state level for Oregon and Washington, there is no portability. So each person has their exempt amount. Oregon, 1 million. So in that same example, if my couple are Oregonians, the first spouse dies, the first 1 million in their estate is not subject to estate tax. If that exemption is not used, and it's usually designed out in their estate plan to kind of shelter some assets so it's not later taxed, it's not used, then it's lost. And that means the surviving spouse has their own exemption of $1 million, but they can't take the deceased spouse's exemption like they can on the federal level. So there's two kind of discrepancies on the federal level and the state level when we're talking about Oregon and Washington. So there's no portability in Oregon and Washington. I know this is kind of getting a little technical, but I just want to overall generally describe some of the differences. And if you think about it, and in my perspective, in terms of planning, it's actually a little bit more challenging and more complicated to plan when you have a state level estate tax that does not follow the federal level estate tax. It makes the plan more complicated. It just does. Okay, so let's talk about tax rates. On the federal level, the estate tax rate is between 18 and 40%. So if we're dealing with an estate that has more than their exemption amount, that anything above that amount will be taxed between a rate of 18 to 40%. That 40% threshold is reached pretty quickly and early on the federal level. For Oregon estate taxes, the tax is between 10 to 16%. So anything over $1 million will be taxed at 10%. And the more assets that are above that $1 million threshold, the tax gradually goes up, capping out at 16%. Washington is the same. It starts at 10% and goes to 20% for those estate taxes. So something just to keep in the back of your mind while we talk. We talked about the estate taxes on the federal and state level. We talked about the exemption and we talked about portability. So now I want to talk about gift taxes. So the difference between estate taxes and gift taxes are assessed on assets given away during a person's life. So estate taxes is assessed when a person dies based on what that person owns. Gift taxes are assessed on gifts made during life. It's important to know that distinction because one strategy many people take to reduce the overall value of their estate, so therefore they are paying less in estate taxes, is to gift during lifetime. But when it comes to federal gifting on the federal level, gifts made during life can reduce the estate exemption that person has. For example, one person dies, they have an exemption of $13.61 million typically, but they made a $5 million gift during their lifetime. When they make a $5 million gift during their lifetime, they have to file a gift tax return. It's a Form 709 to report the gift. And guess what? That $5 million gift reduces the amount available that can pass free of estate taxes. So it reduces that estate exemption amount. So with a $13.61 million someone dies in 2024, they previously, during their lifetime, had made a gift of $5 million or an accumulation of gifts of $5 million. Their federal exemption is reduced by $5 million. I need to do my math here. So I think their exemption would be $8.61 million. So that's how on the federal level, the gift taxes and the estate taxes are tied. If you make a gift during lifetime, and it's an accumulation. So you can make a $100,000 gift, in 2022, another $100,000 gift in 2023, another $100,000 gift in 2024. You die in 2024, your estate tax exemption would be reduced by $300,000 because those are the gifts that you made during life. So important to note, I will just plug in here, there is something called the annual exclusion gift. Essentially, if a gift to an individual is over $18,000, that's when we have to file the gift tax return. So you can gift up to $18,000 per person per year, and it will not be required to be reported on that gift tax return. There will not be a tax due, and it will not reduce your federal exemption amount. And when I say per person, if I, Tammi Caress, am giving a gift to my 4 nieces and nephews, and I'm giving them each $18,000, I don't have to report that gift because it's under the threshold that's required to be reported. But if I were to gift $100,000 to each of my nieces and nephews, then I would have to report that gift because it's over $18,000. That is the annual exclusion gift. And I don't want to confuse that with this reporting requirement with the gift taxes. Now, I keep recalling a reporting requirement. It is a gift tax return. There is not on the federal level a gift tax assessed unless you have made enough gifts during your lifetime to reduce your federal estate tax exemption amount to 0. So essentially, under today's $13.61 million exemption amount, no person who makes a gift will have to pay a gift tax unless they have made an accumulative lifetime gifts of over $13.61 million. Hope that makes sense. Now, gift taxes on the state level. I'm not going to talk about any states except Oregon and Washington. Oregon and Washington do not have a gift tax. So there are some planning opportunities if you are an Oregon resident or a Washington resident and your estates will be subject to estate tax at death because you have more assets than the exempt amount. So we're talking between, $1 or $2 million, depending on which state you live in and where you own property. So one thing that you can do, and I do have clients that have done this, is maybe you're an Oregonian, you have a $2 million estate. You found out that your health, you're not as good as maybe you had a diagnosis, or you're just aging and you want to start, you have enough money to pay for yourself and what your needs are, but maybe you want to get some assets out of your estate. You can actually make some gifts. And if a person were to if they had a $2 million estate and they were to make a $1 million gift or maybe a $1.5 million gift to their loved ones, they've effectively reduced the value of their estate under $1 million. So when they pass, there will not be estate taxes. That gift on the estate level, there's no gift taxes. So there would be no taxes due. And there would be just a reporting requirement on the federal level, but again, no gift tax due. So that is a strategy I've helped some clients implement when it makes sense. Please, I'm not saying go out and do this without professional assistance, because there are other reasons why you may or may not want to do that, because there are income tax considerations as well. But there is a planning opportunity there. The exemption on the federal level is set to expire at the end of 2025. So there's some more planning opportunities to consider. What does that mean? Basically, at the end of 2025, so January 1st, 2026, as long as there's no changes, the estate tax exemption amount will be reduced. We talked about that a little bit already. So what can you do now to use up this $13.61 million exemption? You can actually make gifts, just like I talked about on the state level. So let's pretend there is a person who has a $10 million estate. Right now, if they pass, there's not going to be a federal estate tax. That's because they have less than the exemption amount required to file and pay an estate tax on the federal level. But in 2026, when the exemption amount goes back down to $5 million, adjusted for inflation, they do have a federal estate tax problem, and their estate will pay a federal estate tax as long as the laws don't change. So what can they do? Well, they actually could take their $10 million estate and say, well, I'm going to go ahead and make a big gift to my loved ones before January 1st, 2026. I'm going to make a gift of $5 million. That's going to put my estate down to $5 million, which will be under the threshold set for 2026. Therefore, when that person passes, they've already gifted out $5 million of their estate. They have $5 million left, which will be under the exemption amount, and there won't be a federal estate tax due. And they essentially have escaped federal estate taxes. So 40%, that 40% threshold, that person would have been at that 40% threshold had they not made the gift before January 1st, 2026, which is pretty substantial. You're talking about a $5 million taxable estate. You're looking at 40% of that going to the IRS. And so by gifting, they've minimized all that. Some concerns that people have with doing this would be, well, does that mean that when the exemption reduces, is the government going to come back and claw back, if you will, and say, well, you made a $5 million gift. Now the gift exemption amount is $5 million. So you've used up all of your exemption, and therefore the rest of your estate is going to be subject to tax. The answer is no. There actually is a Treasury regulation addressing this. And essentially, the IRS is not going to come back and claw back the gift that was made in prior years and apply it to the new exemption. It's going to be applicable at the time of the exemption amount, at the time of that gift. Hope that makes sense. Again, there's no state consequences for Oregon and Washington. I also want to talk a little bit about life insurance here. Life insurance death benefit proceeds are included in an estate when a person passes. So, I have a lot of my younger families who still have young children, and they may have that 20-year term insurance policy. They have a $2 million policy, a very low premium. It's a great strategy to protect your family, but that $2 million death benefit will be included in your gross estate. We can have a trust own the insurance policy, and we can have the policy name the trust as its beneficiary. And it's called an irrevocable life insurance trust, by the way. And in that event, we can actually remove that life insurance death benefit out of the estate and therefore not subject to estate taxation. So some other strategies to reduce the estate taxes or some planning opportunities. I know this is a super technical episode, and I apologize for that. I was trying my best to try to make it in a digestible format. I do want to emphasize that, please, any of the planning opportunities that I talked about, talk to your professionals, advisors before you try to implement any of this. Like I said, every situation is unique. There may be reasons why we want to make gifts or don't. And if we are making gifts, we want to be very strategic on the type of assets we are actually gifting. And I know when I work with this with my clients, I want to be talking with their financial advisors if they have one, because I want to make sure that before any gifts are made, my clients are going to have enough assets to sustain their quality of life that they have now. So it's always super important to weigh those sorts of factors as well. So definitely, please consult with your CPA, your attorney, and your financial advisor before making these large gifts. Super, super, super important. I think that brings us to the end of this episode. I hope you found the discussion on estate and gift taxes informative and helpful today as you plan for yourself and your family's future. Just remember, understanding these complex topics is just the first step in making informed decisions. I don't expect you all to be an expert after this episode. That's why it is super important to consult with your professionals. If you enjoyed this episode, I encourage you to subscribe, and I would love it if you would give us a 5-star review as well. Your feedback is super important. It helps us reach more listeners like you who are eager to protect your legacy and your family. If you have any questions or topics you would like us to cover, please reach out to us via our website or on our social media platforms. We love hearing from you and are always here to help. Until next time, stay informed, stay prepared, and keep making those wise legacy decisions. Thanks for listening, and until next time.